Today, we are going to study a very important idea in corporate finance. Value is not created when a deal is announced. Value is created only when the organization actually performs better after the transaction. This is a powerful way to think about mergers, acquisitions, divestitures, spin-offs, restructuring, and private equity. The headline may say that two companies are combining, or that a division is being sold, or that a business is being separated into a new public company. But the finance question is always deeper. After the transaction, who owns the assets? How are those assets governed? What incentives guide managers? How will cash flows improve? And what risks could prevent those improvements from becoming real? In this lecture, we will connect strategy to finance. We will see why integration risk matters, why restructuring can create value, why divestitures and spin-offs are not simply smaller company decisions, and why private equity focuses so heavily on incentives, leverage, operating improvement, and exit discipline. So as we begin, remember this central principle. A transaction is not the finish line. It is the starting point for execution. Let's begin with the difference between announced value and realized value. Before a deal closes, managers estimate synergies, integration costs, transaction costs, and the price they are willing to pay. These estimates form the expected value of the transaction. But after the deal closes, reality begins. Customers react. Employees make decisions. Systems must be integrated. Managers must deliver on promises. The market eventually observes whether the original expectations were realistic. The important idea is simple. Value depends on actual synergies, actual integration costs, the premium paid, and transaction costs. If the benefits are lower than expected, or if the costs are higher than expected, value disappears. This gap is called execution slippage. It can happen because synergy estimates were too optimistic, costs were underestimated, benefits arrived later than planned, or the deal disrupted the existing business. That is why integration risk is valuation risk. It affects the amount, timing, and uncertainty of future cash flows. A disciplined buyer does not wait until closing day to think about integration. Integration risk should influence valuation, negotiation, financing, communication, governance, and the maximum price the buyer is willing to pay. Now, let's look at the major sources of post-merger integration risk. Integration risk appears in many forms. Some risks are visible during due diligence, while others appear only when the two organizations begin operating together. A strong finance manager tries to identify the most important risks before the bid is finalized. Culture and leadership risk can create decision delays, internal conflict, unclear authority, and loss of trust. Systems and data risk can create reporting errors, cybersecurity exposure, and operational disruption. Customer and revenue risk can lead to customer defections, brand confusion, service problems, or lost cross-selling opportunities. Employee and talent risk is also critical. Key employees may leave, morale may decline, and institutional knowledge may be lost. Operations and supply chain risk can affect production, procurement, quality, and working capital. Controls and compliance risk can create governance problems, regulatory issues, and reporting delays. One important point is that integration risk is buyer-specific. The same target may be very risky for one buyer and much less risky for another. A buyer with experience, strong systems, and clear leadership may be able to realize synergies that another buyer cannot. Culture is not just a soft issue. Culture affects financial outcomes because it determines how decisions are made, how customers are treated, and how quickly the combined firm can act. Let's focus more closely on systems, customers, and employees. Systems integration is one of the most practical sources of deal risk. Companies may use different accounting systems, enterprise platforms, customer databases, cybersecurity protocols, human resource systems, and data definitions. These systems affect billing, ordering, reporting, procurement, payroll, customer service, budgeting, and internal controls. A systems plan usually involves one of three choices. The firm may adopt one platform, temporarily maintain separate systems, or permanently keep some systems separate. None of these choices is automatically best. The right choice depends on cost, risk, timing, operating continuity, and the value of integration. Customer retention is just as important. Revenue synergies are often more uncertain than cost synergies because they depend on customer behavior. Customers may worry about service quality. Sales teams may become distracted. Channel partners may feel threatened. Competitors may use the transition period to attack important accounts. Employees are another major source of value. Many important assets do not appear directly on the balance sheet. Engineers, sales leaders, product managers, plant managers, procurement teams, and local market experts may be essential to the deal thesis. Retention agreements can help, but money alone is not enough. People also need clarity, credibility, autonomy, career opportunities, and confidence in leadership. The integration plan should align incentives, performance metrics, and decision rights with the economic logic of the transaction. A synergy estimate should not remain a broad promise. It should become an operating plan. For each expected benefit, managers should identify the source of the synergy, the owner responsible for it, the deadline, the required cost, the performance metric, and the risk that could prevent realization. This turns the synergy story into something measurable. The baseline is especially important. Before we can measure improvement, we must know what costs, revenue, working capital, or cash flows existed before the transaction. Then we ask, what specific action will create the benefit? Who owns that action? When will the benefit begin? What spending is required? How will we avoid double counting? Timing matters because a delayed benefit is less valuable than an immediate benefit. Even if a synergy eventually arrives, a delay reduces its financial value. Also, implementation capacity is limited. Customers, employees, suppliers, systems, and managers can absorb only so much change at one time. That is why disciplined buyers test multiple versions of the synergy case. A base case should include benefits that are probable, measurable, and supported by an implementation plan. An upside case may include additional opportunities. A downside case should consider lower benefits, slower timing, higher costs, or revenue leakage. Finally, integration risk should affect bid discipline. The objective is not to win the auction. The objective is to create value. Now let's move from integration to corporate restructuring. Corporate restructuring means changing the firm's asset mix, ownership structure, financing structure, or organizational design. It includes divestitures, asset sales, spin-offs, split-offs, recapitalizations, cost restructurings, changes in business unit governance, and broader strategic refocusing. Restructuring can create value when the current structure prevents assets from being used in their highest value form. Maybe the asset does not fit the company's strategy. Maybe capital is being allocated poorly. Maybe headquarters complexity is too high. Maybe investors cannot clearly understand the business. Maybe a unit would perform better with different incentives, different management, or different ownership. The restructuring question is similar to the acquisition question. Would these assets be worth more under a different owner, structure, strategy, or financing plan? This perspective is important because corporate finance is not only about buying companies. Value can also be created by selling, separating, simplifying, refinancing, or reorganizing. But restructuring should begin with a clear diagnosis. Managers should not restructure just to appear active. They should identify the source of underperformance and explain why the proposed change addresses that source. A non-core asset may need to be sold. A strong but hidden business may need to be separated. A highly levered firm may need refinancing. A weak operating unit may need management change rather than a sale. Let's examine divestitures and asset sales. A divestiture is the sale of a business unit, subsidiary, product line, asset group, or investment. An asset sale is narrower because it involves the sale of specific assets. In both cases, the firm removes assets from its structure and receives proceeds that can be used to reduce debt, reinvest in core businesses, repurchase shares, pay dividends, or improve liquidity. A divestiture can create value when the asset is worth more to another owner than it is to the current firm. That may happen because the buyer has better operating capabilities, stronger distribution, greater scale, more relevant technology, lower financing costs, or a stronger strategic need for the asset. Focus on the economic intuition. Compare the sale price with the value of the asset under current ownership. Then adjust for transaction costs, stranded costs, and strategic benefits. Stranded costs are often the hidden problem. If a division is sold, but the parent company keeps much of the headquarters cost, information technology cost, facility cost, or pension obligation, the economic benefit may be smaller than expected. A divestiture also has opportunity costs. Selling an asset may generate cash today, but it may also eliminate future strategic options. The firm must ask whether the asset is genuinely more valuable elsewhere or whether short-term pressure is driving the decision. Now let's discuss spin-offs, split-offs, carve-outs, and refocusing. A spin-off separates a subsidiary or division into an independent public company with shares distributed to the parent company's existing shareholders. A split-off also separates a business, but shareholders typically exchange parent shares for shares of the separated company. An equity carve-out sells a minority stake in a subsidiary to public investors, often while the parent keeps control. A full sale transfers the business to another owner. These structures can create value by producing more focused companies, clearer strategies, more transparent reporting, and more tailored capital structures. But separation is not automatically value creating. It can increase costs, reduce purchasing power, duplicate public company expenses, complicate customer relationships, and weaken risk sharing across businesses. The case for separation should explain why focus, transparency, capital allocation, incentives, or strategic flexibility will improve enough to justify the costs. A focused firm is not necessarily a firm with only one product or one geography. A focused firm is a firm whose businesses make economic sense under common ownership. The question is whether the combination of assets creates more value than it costs. A conglomerate discount may suggest that investors value the combined company below the estimated value of its separate parts. But that is not proof that separation will create value. Managers must also consider taxes, transaction costs, dyssynergies, stranded costs, debt allocation, pension obligations, credit ratings, and whether the separated firms will have enough scale to operate independently. Operational restructuring is another major form of value creation. A firm may restructure because of weak margins, poor asset productivity, slow growth, inefficient working capital, high costs, or weak strategic execution. Operational restructuring may involve closing facilities, reducing management layers, renegotiating supplier contracts, redesigning processes, selling underused assets, changing pricing, improving working capital management, or replacing leadership. The financial logic is similar to capital budgeting. The firm invests cash, managerial attention, and organizational disruption in exchange for expected future cash flow improvement. A restructuring program creates value only if the improvement is worth more than the cost and risk of implementation. The difficult part is distinguishing sustainable improvement from temporary cost cutting. A company can improve near-term earnings by cutting maintenance, training, product development, customer service, or sales support. But those actions may damage future cash flows. Value-creating restructuring improves the long-term ability of the firm to generate cash. This brings us to the private equity perspective. Private equity investors often describe their model as buy, improve, and sell. The improvement step is essential. Value does not come simply from taking a company private. Value must come from better revenue growth, stronger margins, improved working capital, better capital efficiency, stronger governance, better incentives, responsible leverage, add-on acquisitions, or a disciplined exit. Platform acquisitions and add-on acquisitions are especially important. A strong platform can integrate add-ons and build a larger, more valuable business. A weak platform can become overwhelmed by complexity. Let's bring everything together. Private equity transactions often use significant debt financing. Leverage can increase equity returns when enterprise value grows and debt is paid down. But leverage can also increase financial risk when cash flows underperform, interest rates rise, refinancing markets tighten, or integration takes longer than expected. Debt can create discipline because managers must focus on cash flow, working capital, capital expenditures, and operating efficiency. But debt does not make a weak business strong. It magnifies outcomes. Strategic buyers and financial buyers may value the same target differently. A strategic buyer may expect operating synergies from combining the target with existing operations. A financial buyer may focus on standalone improvement, governance, leverage, add-on acquisitions, and exit value. Neither buyer is automatically better. The better owner is the one that can create and capture the highest risk-adjusted value. This also helps us distinguish real value creation from financial engineering. A transaction creates sustainable value when it improves cash flow generation, reduces risk, improves capital allocation, strengthens governance, or moves assets to owners who can use them more effectively. Before approving any restructuring, sale, separation, or private equity transaction, managers should ask, what problem are we solving? Why is the current structure not best? Who is accountable for the cash flow improvement? What costs and risks are we creating? What downside scenario would make the transaction unattractive? The central lesson is clear. Transaction value is earned after the strategic decision is made. Thank you for joining me today. I hope this lecture helped you think more clearly about integration risk, restructuring, divestitures, spin-offs, and private equity.